Most people don't actually want to build wealth. They want to feel like they're building wealth. And that's a hard truth, because when it comes to the debate between index funds and real estate, what most beginners are really asking isn't which one builds more wealth. They're asking which one sounds more impressive at dinner. Is it better to say you own rental properties, or that you consistently invest in index funds every month? But here's the uncomfortable reality. Wealth is not built on what sounds exciting. It's built on what works consistently over decades. If you want honest, calm, no-hype breakdowns of money decisions like this, make sure you like this video, subscribe to the channel, and comment below which side you've been leaning toward, index funds or real estate, because by the end of this, you might see both very differently. Let's start with a mindset shift. The real question isn't which asset class is superior in theory. The real question is which vehicle helps you consistently stay invested long enough for compounding to do its job. Because compounding is quiet. It doesn't show off. It doesn't send you congratulatory messages. It just works in the background for those who stick with it. And this is where beginners go wrong. They compare highlight moments instead of lifetime outcomes. They see someone flipping houses and making a big profit and think that's the standard. Or they see a stock market crash and assume index funds are dangerous. But wealth is not about isolated events. It's about long-term systems. Index funds, at their core, are simple. When you invest in a broad index fund, you're buying a small piece of hundreds or even thousands of companies at once. You're not trying to guess which company will win. You're owning the market itself. Historically, broad stock market index funds have produced strong long-term returns over decades. Not every year, not every month, but over time. They require very little effort. You invest consistently, reinvest dividends, and allow compounding to work. There are no tenants calling you at midnight, no property taxes to negotiate, no maintenance surprises. The simplicity is their strength. Real estate, on the other hand, feels more tangible. You can touch it, you can improve it, you can borrow against it. And leverage is one of the biggest arguments in its favor. With real estate, you can control a large asset with a relatively small down payment. That leverage can amplify gains if the property appreciates and rental income covers your costs. But here's what most people misunderstand. Leverage amplifies losses too. If rents drop, if vacancies increase, if interest rates rise, your margin shrinks quickly. Real estate is not automatically safer just because it's physical. Now pay attention to this part, because this is where the wealth-building comparison becomes real. When you compare index funds and real estate, you have to look beyond returns and examine time, stress, liquidity, and scalability. Index funds are liquid. If you need money, you can sell part of your holdings quickly. Real estate is illiquid. Selling a property can take months, involve fees, negotiations, inspections, and uncertainty. Index funds are scalable. You can invest an extra $100 or $10,000 without changing your lifestyle. Real estate often requires significant capital and commitment each time you expand. Common mistakes in this debate usually come from emotional bias. People overestimate the control they have in real estate and underestimate the discipline required in index investing. With rental properties, you might feel active and productive because you're making decisions, managing tenants, upgrading kitchens. With index funds, it feels boring, and boredom can be uncomfortable. But boredom is often where wealth quietly grows. On the other side, some investors assume index funds require no emotional strength. That's not true. During market downturns, when your portfolio drops 20 or 30% on paper, it tests your discipline deeply. Selling in panic destroys years of compounding. Here's the deeper concept that actually builds wealth. Consistency multiplied by time, protected by discipline. It doesn't matter whether the vehicle is index funds or real estate if you constantly interrupt the process. Someone who buys one rental property and then sells it out of frustration after a bad year won't build lasting wealth. Someone who invests in index funds for 3 years and quits during a market downturn won't either. The vehicle matters less than the system behind it. Let's talk numbers conceptually without hype. Index funds historically have produced steady long-term growth when held for decades. They benefit from global economic expansion, innovation, and productivity growth. You don't have to predict which company becomes the next giant. You simply stay invested. Real estate builds wealth through appreciation, rental income, tax advantages, and leverage. But it requires active management or property management fees. There are transaction costs when buying and selling. There are maintenance costs that never make it into optimistic spreadsheets. This is where beginners go wrong again. They compare gross returns instead of net outcomes. They see someone say, "My property went up 15% this year," but they don't subtract mortgage interest, repairs, insurance, vacancy, and time. With index funds, costs are transparent and usually low, especially with broad market funds. That cost difference compounds over decades. A small percentage saved annually can translate into significant long-term wealth. Now let's move into a practical framework you can actually use. Step 1 is assessing your personality and lifestyle. Are you comfortable managing assets actively? Do you have the time, patience, and emotional resilience to handle tenants, paperwork, and unexpected expenses? Or do you prefer automation and simplicity? Step 2 is analyzing your financial position. Do you have stable income, emergency savings, and low high-interest debt? Real estate often requires upfront capital and financial stability. Index funds can be started with much smaller amounts consistently invested. Step 3 is understanding leverage honestly. Leverage can accelerate wealth building if used conservatively and managed responsibly. But over-leveraging in real estate, especially in uncertain economic environments, can create stress that forces poor decisions. Index funds typically involve little to no leverage for most long-term investors, which reduces risk of catastrophic loss, but also limits rapid upside. Step 4 is diversification. One rental property in one city exposes you to concentrated risk. A broad index fund spreads risk across sectors and regions. Over time, diversification reduces the impact of individual failures. And diversification is not about avoiding risk entirely. It's about avoiding irreversible damage. Emotional discipline plays a massive role here. With index funds, the discipline is to stay invested when headlines are negative and markets are volatile. With real estate, the discipline is to maintain reserves, avoid overpaying, screen tenants properly, and resist expansion beyond your financial capacity. Both require patience. Both punish impatience. Here's what most people misunderstand about wealth building. The biggest returns often come from staying consistent when others quit. It's not about choosing the flashier option. It's about choosing the option you can stick with for 20 or 30 years. If real estate excites you and you're willing to treat it like a business, it can absolutely build substantial wealth over time. If you value simplicity, low maintenance, and broad diversification, index funds can quietly and powerfully grow your net worth. There's also a hybrid approach that many disciplined investors eventually adopt. They build a strong foundation with index funds through automatic monthly investing, then selectively add real estate once their financial base is stable. This reduces pressure. It allows real estate decisions to be strategic instead of desperate. And it keeps the core of their wealth diversified and liquid. Now pay attention to this part, because this is where clarity replaces confusion. The question, which actually builds more wealth, cannot be answered universally. It depends on time horizon, behavior, cost control, and risk management. Over long periods, both have historically created significant wealth for disciplined investors. But neither forgives emotional decision-making. Neither rewards impatience. If you are just starting, simplicity often wins. Automating investments into a broad index fund while building financial literacy and savings habits can create a powerful base. Once that base is strong, adding complexity like real estate becomes a strategic choice, not a gamble. So here's the recap. Index funds offer simplicity, diversification, liquidity, and historically steady long-term growth with minimal effort. Real estate offers leverage, tangible assets, income potential, and greater control but demands time, capital, and active management. The true wealth builder is not the asset itself. It's your system, your consistency, and your emotional discipline over decades. If this breakdown helped you think more clearly about your next move, like the video, Subscribe for more calm and realistic finance education, and comment below which path fits your personality better right now. And if you want to go deeper into building a disciplined investing foundation, you'll want to watch the video titled Stop Saving Money: The New Rule of Finance, because understanding your behavior is often more important than choosing the perfect asset.